Not just the United States, but the entire global economy is at a critical turning point. If inflation starts to climb again, it won't just affect price tags. It will directly impact your investments, interest rates, and even the stock market. The US CPI data for June, which is being released today, could simultaneously shape Powell's fate, the Fed's roadmap, and Trump's policies. Sounds crazy, doesn't it? But that's exactly why you need to watch this video carefully. We're just getting started, but let me remind you right now. To avoid missing critical insights, take control of your financial future with informed decisions and become part of this growing community. Don't forget to like this video and subscribe to our channel. Every like and subscription helps us reach more people and grow this movement of economic awareness. Now let's get to the heart of the matter. While inflation data in the US has remained calm in recent months, this calm could be the quiet before the storm. Because there's a powerful factor silently stirring the waters beneath the surface: Trump's trade tariffs. Federal Reserve officials, including Powell himself, have warned that the effects of these tariffs would gradually begin to show during the summer. And now, we're exactly in that time frame. Tonight's CPI report is the first real test of that impact. If the numbers come in higher than expected, it could directly shake the Fed's plans to cut interest rates. So what are the expectations? Economists project that in June, the annual inflation rate will rise to 2.7%, with core inflation hitting 3%. Significant price increases are anticipated in tariff-sensitive categories like furniture, cars, and toys. While May showed a decline in these segments, many now believe that was temporary. Companies were simply clearing out inventory. As those stockpiles run out, the true impact of the tariffs is starting to show up in consumer prices. That's why this June data isn't just about numbers. It's become the stage for a strategic and political showdown. Now enter the key players. On one side, you have Trump, eager to see interest rates come down. On the other, Powell, cautiously applying a wait-and-see approach to keep inflation pressures under control. The interesting twist? Their policies directly clash. Trump defends the tariffs, while Powell argues that these very tariffs are fueling inflation. Here's the irony. If inflation doesn't rise as expected, Trump will likely attack the Fed, saying, "Why haven't you cut rates yet?" But if inflation does rise, Powell will say, "See? We were right, but the Fed will have to postpone rate cuts again." Either way, the tension between them will escalate. What are the markets saying? According to JPMorgan, if core CPI exceeds 0.37%, the S&P 500 could drop by as much as 2%. Softer data, on the other hand, might give stocks some breathing room. But remember, this is not just about numbers. It's also about how markets interpret the Fed's intentions. Bond markets are still signaling that inflation is under control. But if there's a surprise uptick in today's report, big investors may quickly shift direction. That could lead to serious turbulence in the stock market, especially in tech stocks, which are more sensitive to interest rate speculation. In conclusion, today's CPI report is not just an economic indicator. It's at the very center of Washington's power dynamics, monetary policy strategy, and market psychology. If inflation rises, rate cut dreams might be delayed yet again. If it falls, Trump might once again target Powell for being too cautious. Either outcome spells one thing for the markets: volatility. If you found this analysis helpful, make sure to like the video, share your thoughts in the comments, and subscribe to be part of this growing movement of economic awareness. Your engagement helps us grow this community and bring more clarity to these complex financial topics. See you in the next video.